Professor, it's great to see you. Always great to get your thoughts. So let's talk about why July. It does seem much more reasonable and consensus and less aggressive than the market would expect.
I don't have a huge quarrel with the survey that says June. There's no difference between June and July. I think the economic community is correct in being less aggressive than where the futures market is. It's the difference between economics and money management. So I don't have any quarrel with that consensus. And I think the fundamental issue is that there is no urgency for the Fed to ease. In the fullness of time, they need to ease to validate what the marketplace has already done in easing financial conditions, which will be supportive of the economy. But there's no urgency for them to do that. It's only over time, as well as the fact I think they have to guard against being too aggressive in their rhetoric about easing because of the risk that financial conditions will not just be comfortably easier, but too exuberant.
Now, Paul, what exactly in your mind is giving the Fed that extra time, that extra cover? What are the market conditions that you're seeing? And what exactly is the data showing you that says the Fed does not have to be urgent about lowering interest rates to help spur some economic activity?
Well, I think the data is speaking for itself, including the fourth quarter GDP, the employment data, the consumer confidence data. There's just a whole plethora of data that's saying that there is no urgency about easing because there is limited visible downside to the economy. And with respect to the markets, it's important to recognize the markets have eased a potload over the last 3 months. We're down more than a full percentage point on mortgage rates. The entire long end of the curve is mirroring that. We also have the positive animal spirit effects of the equity market, and corporate spreads are tight and getting tighter. So there is nothing in the financial markets that is restraining economic growth right now, and the data is fine. So when you look at that as a Fed official, there's no sense of urgency. You know you got to ease in time to validate what the market has done, but you can do it on your timetable as opposed to bullying from the markets.